right, our next topic is audit related services. Auditors perform a lot of services to their clients, and they also do other what we call audit related. They are like audit, but they are not audit per se, they are related. Okay, that is a service auditors also provide in addition to the audit to their clients. Okay, the first one is review engagements. Review engagements. Let's see what is review engagement. The distinction between audits and audit related services. There's a difference between audits and audit related services. So let's know. An audit is a form of assurance engagement. Anybody that performs an audit is going to give an assurance to the clients. So the objective of an audit is to enable the auditor to form an opinion. That means you are giving an assurance as to whether the financial statement of an entity give a true and fair view. So if it's not true and fair, it means you're also giving assurance that the financial statement is not. If it is true and fair, then you say the financial statement as prepared by the what? Management is in accordance with what? So and so. So it is now in contrast, which is audit related services, do not provide the same high level of assurance, and in some cases do not provide any assurance at all. So we have what we call high level assurance and then what? Low level assurance, which we call limited assurance. Limited assurance. Reasonable assurance is an audit where it is you do a lot of work. So we call it high level assurance. But if that is where you say true and fair or it's not true and fair because of the quantum of work you have done. But as far as audit related services are concerned, they are not what? High level assurance that you provide. And we also call it what? Limited assurance. Now, audit related services include what? Engagement such as what? Review of data. Somebody will give you just review the data for us. It's not an audit. Therefore, you can give what? Reasonable assurance. So in this case, it's what? Limited assurance you are going to give. So in reviews of data are checks carried out on information prepared by another person. They provide a moderate level of what? Assurance that the information and the review is free of material misstatement. So in that case, you have no reasonable assurance. Therefore, you cannot specifically say, oh, the financial statement is true and fair, or it is not true and fair. But you have a way of saying it. Okay? Agreed upon procedures. This is an engagement where a party hiring the practitioner specify the procedures that the practitioner should follow when performing the assignment. Yes. Somebody can give an assignment, your client can give you an assignment and specify the procedure you must follow in coming out with your opinion or your reports. So that one is agreed upon. The two of you have agreed upon it. Compilation is the next one. The practitioner is engaged to prepare information rather than to audit information prepared by someone else. Compilation in another way is called what? Accounting. So you compile the figures for your clients, but you are not auditing it. So you don't give opinion on it. Types of review engagement. Types of review engagement. The first, we have in review engagement, the practitioner is engaged to review financial information or other information, but not to audit it. Just review it and give your what? Your opinion on it. A distinction is made between two types of review engagement: an attestation engagement and a direct reporting engagement. So these are the two main types of what? Review that you normally do. Attestation engagement and what? Direct reporting. Now, what is attestation engagement? To attest to something means to confirm it or vouch for it. In an attestation agreement, a practitioner is engaged to attest to something, to attest to confirm whether that is an attestation. The practitioner will not comment on the quality of the procedures, but will simply attest to the fact that they have been performed. Assuming you have written application to a company and the company want to engage you. They may ask probably somebody, let's say you go to Britain and then you have got employment. They may send a letter to Ghana to confirm if you attended University of Ghana, to confirm whether, or you have chartered CA, to confirm whether actually you have what? You have passed ICA Ghana. So that is attestation, a sample of attestation. Direct reporting engagement. In a direct reporting engagement, a practitioner is what? Engaged to provide a special report on some aspect of the client's affairs. The report will provide an expression of opinion, usually providing limited or negative assurance. So we call it either limited assurance or what? Negative assurance. That is made in accordance with the agreed terms of the engagements. The report is prepared after the practitioner has carried out an independent examination of financial information or other information that has been prepared for use by another party. Due diligence engagement. Due diligence engagement. Due diligence engagement work is most commonly referred to in the context of what? Mergers and takeovers. When companies are coming together or one company is taking over another, that is where due diligence works. The objective should be to find out everything that may be relevant about the target company's operations, financial performance, financial position, and future prospects. And then the main objective for due diligence is to decide whether a takeover or a merger is actually desirable. And then the next one is, if so, whether the proposed cost of the acquisition is reasonable, or on the other hand, the adverse may come. An adverse or a critical due diligence report may therefore result in abandoning a proposed takeover or a merger, or reducing the offer price for the acquisition. So due diligence is background check. That is what I can easily say. It's a background check to confirm or deny a certain information. Items investigate in what? Due diligence exercise. So if you are doing due diligence, areas you have to what? They are saying that the practitioner will look at the available historical financial information about the target company. So assuming takeover is going on, that target company, the investigator will have to get more information about the target company, such as its financial statement for the past few years. It can be 3 years, 5 years. Then operational issues. They also investigate the operational issues. The practitioner should also look for any operational issues in the target company that may raise questions about its value. Okay? Then management representation. Management of the takeover target may have provided representation to the potential buyer. Now, identification of assets. Because you are doing takeover, therefore you need to identify the assets. So a takeover usually results in purchase goodwill in the consolidated accounts. However, the takeover target may have several intangible assets. Yes, intangible assets like what? Goodwill, patent rights, and the rest, that do not appear in its statement of financial position, but which should be recognized for the purpose of consolidation. So if you are going to do the consolidation, you need to take, because goodwill, if it is not purchased, you don't pay for it. It doesn't appear in the financial statements. Therefore, you need to look at those things. The benefits and costs of a takeover. Due diligence may also include an attempt to estimate the future benefits of what? The takeover, such as cost savings from synergies, such as what? Economies of scale, etc., etc. Now, benefits of using an audit firm for due diligence. What benefits will a firm or a company derive if they want to use what? A firm of auditors to do diligence for them. Using an accountancy firm to do the work has two potential benefits. Hiring an accountancy firm to do the work saves management time for the potential buyer. Especially, for example, that's for large takeover, the amount of time and resources required to carry out proper due diligence can be substantial. So if it's a big company, it is beneficial to hire what? An audit firm to do that due diligence for you. Using a professional firm to do due diligence may help to reassure shareholders in the potential buyer that the acquisition has been properly evaluated. Due diligence reports structure. Report is report. Any report you are writing is a report, but due diligence reports also need. Now, the due diligence report should have what we call introduction, or after the introduction, or what we call executive summary. Then the main section of the report. The main section of the report. And the main section should include analysis of what? Audited financial statement going back several years to check whether the company was making profits. Then any audit what? Issues in the what? In the past. Any audit issues in the past. Then legal issues need to be considered. Corporate governance analysis need to be done. SWOT analysis. All these things should be captured in the main report. That's the main content. Any financial what? Obligations such as what? Loans, etc. or lease. Details of key suppliers and the customers. Details of key employment, that's matters such as what? Pensions, redundancy, etc. and the key employees. Then that's appendices, that's attachments. Okay, so the report should capture all these things. Due diligence reports. International standard on review engagement. Now we are coming to review engagement. What is a review? That's objectives of international standard on review engagement. 2,400. Engagement to review historical financial statements states the objectives of a review of financial statements are, so if you are reviewing a financial statement, you are not doing auditing, to obtain limited assurance. So you are not going to do detailed work. So we do a limited assurance, primarily by performing inquiries, audit inquiry, and analytical procedures about whether the financial statements as a whole are free from material misstatements. This is, we are doing what? A review engagement. Then we also have report on the financial statement as a whole. So you must report on the financial statement as a whole and communicate as required by international standard for review engagements. The principles that need to apply in review engagements. Principles that, so international standard for review engagement 2,400 set out the following general principles. That should be applied to a review engagement. So anytime you are doing a review engagement, the practitioner shall comply with our relevant codes of ethics. Don't think you're not doing audit. No, code of ethics is not necessary. No, you are supposed to comply with code of ethics. Then you must also plan and perform the work with what? An attitude of what? Professional skepticism. And what does professional skepticism mean? Being aware of what? Anything that is around you. Having what? A questioning mind. Anything you don't understand, you need to ask so that you are informed. Okay? You must also obtain sufficient appropriate evidence as far as what? The review is concerned. Through inquiry and what? Analytical procedures. You are not doing audits, you are doing analytical procedures. So you are doing inquiry and you are doing analysis. Then you must exercise professional judgment. So these are requirements that you need to follow when you are doing a review engagement. The actual terms of review engagement shall be agreed with the what? Clients and set out in an engagement letter. Procedures for review of financial statements. So if you are given a question to review a financial statement, these are the procedures. Procedures for review of financial statement will usually include the following. So when you are given a question in examination and it's a review, make sure you follow this. You must determine materiality for the financial statement as a whole, as if you are doing audit. Then the practitioner, who is you, the auditor, shall obtain understanding of the entity's what? Business and the industry in which it operates. Then you, the auditor, who is the practitioner, shall make inquiries into what? The entity's accounting policies, practices, procedures, material assertions in the financial statement, the completeness of the accounting records. It's just similar to what? Auditing. But because of quantity of work you are going to do is lesser, that is where we call it what? Review. Then the practitioner will use analytical procedures. You are doing what? Analytical procedure. You are not doing auditing, where you go and do every detailed work. No. You are doing analysis. Other procedures that will usually be carried out in a review of what? Financial statement. Now, reporting at the end of a review engagement. Every assignment that a practitioner does, he or she need to what? Write a report. So review engagement also call for what? A report. The outcome of review engagement will be a report from the practitioner. The report will be in one of two main forms, depending on whether no matters have come to the attention of the practitioner, which indicate that a true and fair view is what? Not presented. So, and then the second one is some matters have come to the attention of the practitioner, indicating that a true and fair view might not be presented. So these are the two main reasons or two issues you have to factor in the report that you are going to. Well, why such matters have come to the practitioner's attention. So if some issue has come to your attention, when matters have come to the practitioner's attention, suggesting that a material misstatement or inability to obtain sufficient appropriate audit evidence exists, the reporting requirements are similar to those in ISA 7 and 5 for qualified external auditors reports. So they are saying that if something has come to your attention, which in actual fact need to what? Qualify the opinion. But in this case, you are not saying qualified opinion because you are not doing more audits. So you have to do, the auditor will need to describe the matters involved. Whatever comes to your attention, you need to describe it. Then assess the impact of the matter as either material or pervasive. Material or what? Pervasive. Then distinguish between material misstatements and limitation on scope when presenting the opinion in the reports. The International Standard on Review Engagements. Now, the auditing firm that reviews interim financial information is normally the external auditor for the end of year accounts. The audit firm should comply with what? The same ethical requirements as it does for the main audits. We learned this already. Whether you are doing a review or not, you need to comply with the ethical requirements. Implement appropriate quality control procedures. Like we also learn in auditing, there is nothing that you do without quality control procedures. So whether you are doing review, any assignments, then you must plan and perform the review with an attitude of what? Professional skepticism. And then agree the terms of engagement with the client in an engagement letter. So for a review work or whatever it is, there is a need for what? Engagement letter. Prepare documentation sufficient to support the auditor's review conclusions and to provide evidence that the review was conducted in accordance with what? International Standard for Review Engagements, 2410. Procedures for the review of interim financial statements. Procedures for review of what? Interim financial information. Procedures for this. The auditor should obtain an understanding of the entity and its environment. It's like auditing, but because of the work you are going to do is limited, you follow the same standard. Okay? The auditors should make what? Inquiries and perform analytical procedure. It's a review sufficient to reach what? A conclusion for the review. If any such matters come to the auditor's attention, if any matter comes to the attention, the auditor should make additional inquiries. Go further. Don't just stop there and say something has come and that's all. Perform other procedures in order to obtain more information. Then the auditor should check that the interim financial information agrees or reconciles to the what? Underlying accounting records. Then the auditor should what? Discover management activities. And then the auditor should what? Evaluate any uncorrected misstatement in the interim financial information, both individually and in aggregates. The auditor should obtain written representation from management. The auditor also should what? Ensure that any other information issued with what? Interim financial information is materially what? Consistent with what? Interim financial information. Consistency. Reporting on the review of interim financial information. How to report on it. There should be a title. That's review of what? That's the example. Review of interim financial information. There should be addressee, and there should be what? You should identify the interim financial state information that has been reviewed. So whatever you are reviewing, you must identify it. A statement that management is responsible for preparing the interim financial information in accordance with what applicable financial reporting. So there should be a statement that you are not responsible for preparing that interim financial information, but rather what? It's management responsibility. Then when the interim financial information consists of a complete set of general purpose financial statements, that should be prepared in accordance with what? A financial reporting framework. And the statements are designed to achieve fair presentation. The review report should include an auditor's what? Conclusion. A statement that the auditor is responsible for expressing a conclusion on the interim financial information based on the review. Based on what? Review, not audit, that the auditor has carried out. A statement that the review of the interim financial information was conducted in accordance with what? The standard. Then a statement that a review is substantially less in scope, less in what? Scope than an audit conducted in accordance with what? ISIS. Then date of the report, location and so forth, and a signature. A qualified or adverse opinion should be given where the auditor or accountant believe that the interim financial information has not been prepared in accordance with the applicable financial reporting framework. So there should be a qualified or adverse opinion. When it comes to report writing, you differentiate between qualified and adverse. Then, if a limitation or scope is imposed, the auditor should communicate to the appropriate level of what? Management. And to those charged with governance, the difficulty the auditor has in reaching an opinion. That limitation on scope should be explained to them. Then they consider whether he can issue a report. And then if there are uncertainties surrounding going concern, then the auditor should modify his report in a manner consistent with what? ISA 570 concern, that is going concern. Agreed upon procedures. Agreed upon procedures is the next. Now, nature of agreed upon procedures. In agreed upon procedures, engagement, the client that engages also decide the procedure that the accountant will follow. So the practitioner take instructions from the clients as to how he or she should do the job and come out with what? Agreed upon. This is very different from an audit engagement. Yes, it's true. Where the auditor decides the procedures to be used, to be followed in order to reach an audit opinion. This is different because the one who gives you the assignment give you the procedure you must follow in arriving at your results. The accountant provides a report on factual findings from the procedures performed. No assurance is provided because it's not an assurance engagement. Okay? Then it is left to what? To the user to assess the procedures and findings, and to draw their own conclusions. So the report issued at the end of an agreed upon procedure should be what? Made available only to those who have agreed the procedures with the auditor or the accountants. Now, related services, international standard or related services. Now, related services, the terms of engagement for agreed upon procedures should be set out in an engagement letter. Then the process undertaken by the accountant to perform agreed upon procedures may be similar to those involved in an audit. Yes. So they look like the same, but no. However, since there is no assurance attached to the what? Assignment, it is likely that the volume of work undertaken by the accountant will be significantly what? Less than for an audit of similar financial information. How do you report on agreed upon? The same thing. Title, addressee, identification of specific financial or non-financial what? Information, a statement that the procedures performed were those agreed upon, and then a statement that the engagement was performed in accordance with what? International standard or related services. Then, when relevant, a statement that the auditor is not independent of the entity. Yeah, if it's not relevant, no problem. Then, identification of the purpose for which the agreed upon procedures were performed. A listing company of specific procedures performed. A listing company of specific procedures. The description of the auditor's factual findings, including what? Sufficient details of errors and exceptions found. Statement that the procedures performed do not constitute either an audit or review. A statement that had the auditor performed additional procedures, an audit or review, other matters might have come to light that would have been reported. A statement that, so all these are statements. Compilation engagements. Nature of compilation engagements. So this is where you prepare the financial. So in a compilation engagement, the accountant is engaged to prepare financial statements from the petty records and the receipts and other information, and not to audit or review the financial statement or other information that has been prepared by someone else. So you are preparing it rather. So they will therefore use accounting expertise rather than what? Auditing expertise. So international standard on related services. The key point of that, an engagement letter is required. Yes, related services, there should be what? Engagement letter. It should also be planned and documented. The accountant also needs to have adequate knowledge of the client business and its operations. And the accountant becomes, if the accountant becomes aware that the information provided is unsatisfactory, he should ask management to correct or improve the information. Then the practitioner must obtain acknowledge from what? Acknowledgement from management or those charged with governance. How do you report? As usual, for the report, I will skip it. It's the same. That's title, addressee, statement that description of responsibilities, etc., etc. Continued up to that level. Thank you.